Corporate finance practice problem using Excel. Rights impact on asset position. Get ready, it's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet and would like to follow along, note that we're in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. Information on the left-hand side, populating that information into the blue area on the right-hand side. Looking at rights, once again, rights offerings, this time from the perspective of the investor or shareholder, looking at the options of either exercising or not exercising the rights. Remember that the rights themselves, and you can take a look at a more detailed problem on the basics of the rights offering in prior presentations where we have that. General idea being, however, corporation wants to generate cash and some capital. Therefore, they would like to issue new stock. In order to do so, they want to give a discounted price or give an option for the current investors, current shareholders, to have a discounted price. So they can do that possibly with the offering of the rights offering. And then now from this perspective, then we're thinking about what would happen if we were to exercise or not exercise the rights from the shareholder side of things. So let's say we're the shares owned. We're imagining we just have 3 shares of the stock, and the market price before anything happens, before the rights issuance, is the $80. Then we have the rights offering. So the rights offering, now the corporation wants to issue more stocks. They would like then to issue or have this discounted price to the current shareholders if they would like to take advantage of that. So the rights per share, they're going to give 1 right per share. We have 3 shares. That means we're going to get 3 rights. Exercise or subscription price, meaning if we were to exercise the rights, we can buy them another share at $64 instead of the current market price of the $80. And the rights required to purchase 1 share at discounted price are going to be 3, meaning we need 3 rights to purchase 1 more share at the discounted price of 64, which of course is exactly how many shares, how many rights we have, because we got 1 right per share and we only had 3 shares to start off with. We're also going to say that we have cash on hand at the 64, which will work out nice and evenly when we look at our complete portfolio, given the fact that if we exercise the right, it's going to cost us that $64. Okay, so what's going to be the value of the right? We've got our equation up top. This is at the issue point. So the right value at the cum rights period is going to be the stock price minus the rights subscription price per share divided by the number of rights required to buy 1 share plus 1. Let's see what that looks like. We're going to say, all right, the stock selling for on rights is going to be the $80. And then the subscription price, the discounted price, that if we were to exercise the rights, or in the wrong cell, if we were to exercise the rights, we're going to say are 64, underlining that, font group and underline. That's going to give us then, I'm going to call it the numerator or difference. I'll put that in the outer column, the 80 minus the 64 or the 16. So then we want the rights needed for 1 share. How many rights do we need to purchase 1 share? I'm going to indent this one, alignment, indent. And then we're going to need 3 rights for 1 share. Then we're going to add 1 to it. So plus 1, underline that, font group and underline. Summing that up equals the SUM. 3 plus 1 is 4. Could have done that one in my head without even using the sum function. And then we have the value of the 1 right then. The value of the 1 right is going to be the 16 divided by 4 or 4. And that one font group, and we're going to say underline. So there we have that. Now, what's going to be the value of the assets before the rights offering? So let's think about this before the rights offering took place. We have the shares that we own. The number of shares that we have are 3 shares. So we had 3 of these shares up top. And the market price is 80. So before they issue the rights or declare the issuing of the rights, we have 80, font group underline. That's going to be the value of the stock. So we'll say that's the value of stock. And so that's going to be equal to 3 shares times $80 per share. That's going to be $240. We also have the cash on hand down here for our total portfolio of $64. We have another $64 of just straight cash. So our total portfolio before this whole thing takes place, the value of assets before the rights offering is going to be equal to the sum of the 240 plus the 64 or the 304. So now let's think about the diluted value or X rights price per share. So we're going to say the market value. We started off with the market value of the $80. And then we're going to say the value of one right. If we think about the value of one right being equal to $4, then we have the diluted or X right per share that we can say is going to be then the 80 minus the 4, or the 76. I'm going to put a font group and underline that. So now, where would we stand? What would our portfolio look like if we participate? So if the portfolio value, if participate in the rights offering based on diluted value X rights stock price. So if we participate, we're going to have the number of shares that we will own after we purchase the new one is then going to be equal to, we started with 3, and then we're going to purchase one more share. We're going to purchase one more share because we were able to purchase it at that discounted price. So I'm going to purchase, I'll just pick up that 1 or 4 shares. And then we're looking to pick up the diluted value. So the value after this took place is going to be, we're going to assume is going to be this 76, that diluted value, given the fact that, of course, when the corporation issues the rights, it's going to result in a decrease in basically the value of the stock. So we had the market price before, we're thinking the $80, and then the value of one right is going to be 4. That's going to bring it down to the $76. You can think about it in a few different ways too. If you think about the total market value of the corporation, you would then be thinking about what the market price is times the number of shares. That's what the market basically thinks the value of the corporation is. If they then issue more stocks for something less than the market price, then they're going to generate cash, but the cash they're going to be generating is less than what the market price would be. So you would once again get to a value that you would think would be less than after you have the rights offering after that point in time. So we got then the shares owned, the diluted value X rights per share. Let's underline that. We're going to put an underline there, and that'll give us the value of the stock at this point. So we're going to say the value of the stock that we have will then be the 4 shares now that we have, but they're only worth the $76. That gives us about the 304. I think that's exact. And then the cash on hand that we're going to have is going to be 0 because we had cash before of the 64, and then we've spent the whole $64 to exercise our option. We spent that $64 plus the 3 rights in order to buy that 1 extra share. So that brings it down to 0. We got no more cash on hand, but our ending position for the value is going to be equal to the sum of the 304 plus 0, or simply the 304. Now let's think what will happen if the portfolio value, if they sell rights and keep stock at the diluted value. So what if they just simply sell the rights then and they keep the stock at that lower valued price? Let's calculate that. We're going to say the shares that they own then after this point in time, they're going to say shares owned are going to be 3 shares because they didn't take that last share. They didn't exercise their option at that point. So we're going to say 3. And then the diluted value now, they're no longer worth $80 per share. They're only worth the 76 that we calculated. So they're worth that 76. Underline that font group and underlining. That's going to give us our stock value in our portfolio, which is going to be 3 times the 76, which will give us the 228. And then we have the rights that basically we're going to let them expire and hopefully get paid basically on the rights. So we're going to say alignment, indent that one. The rights are going to be 3, or you can imagine selling the rights, right? So we're going to say we have 3 rights, and they then the sales price of the rights per right we could sell them for, we calculated up top, is equal to the 4. So the value of one right is 4. So we're going to then underline that by going to the font group and underlining that. That's going to give us the cash for the rights. So we can sell those, or possibly that would be our value that would be provided for us if we let them lapse, and that's going to be 12, which could be called the nil paid price, or if we sell them. And so that I'm going to indent that. So we've got that cash now, and then we have our original cash that we had on that we didn't spend now. We didn't spend them to exercise the option, so we didn't spend the 64 to exercise the option, so we still have that 64 cash. And so let's underline that, font group and underline. That's going to give us our value of the total portfolio in that case. So if we sum this up, equals the sum, and we underline that, we're going to go to the font group and underline, hold on a second, I missed a number, equals the sum of these three numbers. That's going to give us our 304. So we end up with that 304. Of course, the organization of it is a bit different because now we have the stocks that have a lesser value here. We let it lapse, but now we have the cash that basically kind of works out on that side. Now, if before we did any of this, you might say, well, where did we stand beforehand? Well, beforehand, we had the value of portfolio starting point. Let's say portfolio starting point. Let's just put that right here. And that would be the number of shares. So we're going to say shares were 3. We started off with 3 shares, and we started off with a market value at the $80. And that's going to be the value of stock in our portfolio, which would be 3 times the 80. Underlining that, font group and underline, and then we had cash on hand, which was the 64. That is going to be the sum of these two, the 240 and the 64. Underlining that, font group underline, that's going to be the value of the portfolio. And so there we have that. Let's make that blue. We're going to go ahead and make that blue, and let's border it and make it blue. So our starting point was at the 304, and then after this takes place, if we exercise the option, then we're still estimating the 304. And if we don't exercise the option, we're still estimating the 304. Obviously, the starting point, we had we had only 3 stocks, and they were valued at the $80, which was the market price at that point, and we had that $64 in cash. And then if we exercise the option, now we have 4 stocks, but they're slightly less in value due to the effects of the options that's going to take place, and we have no cash, still at the 304. If we then do not exercise the option, we still have an impact, right, on our portfolio, not on the bottom line, possibly, but there's still a difference in what happens, right? Our 3 stocks are now only worth 76 for the 228, and then the rights, if we have the rights that are sold, then we have the $12. So now we have the cash on hand, which is going to be the 64 and the 12 or the 76 to get us to, once again, that 304.